It was a tough day for retail overall. The XRT ETF, that's the one that tracks the space, falling 1.5% today. And check out some of these mall-based names. Names like Macy's, Kohl's, Nordstrom, The Gap, all finishing, as you can see there, deep in the red on the day. And your next guest says there could be even more pain ahead for some of these types of names. Chris White is the CEO of BondClick. Thank you very much for being out here with us. Let's talk about whether or not this retail trade is something that can bounce back, and how exactly do traders and investors play it?
Well, thanks for having me, Dom. I think a big part of looking at the retail sector is being told, or at least the story is being told, really in the debt markets. Obviously, with COVID-19 hitting the market, or hitting the U.S. market in late February, early March, there were a lot of questions as to how retailers would survive. What we saw in terms of the data is that bonds definitely did reprice for the big retailers, Gap, Macy's, L Brands, Nordstrom's, Bed Bath & Beyond. But overall, we saw flat customer flow by volume, which just tells you that the bond investors themselves did not lose faith in retailers and actually were balanced in terms of buying and selling activity. So that happened really. Oh, sorry, go ahead.
No. So I was going to say that, following up on that comment, that implies that there is some kind of a handicapping about the viability of these businesses if the debt markets and debt investors are getting in on the action. What exactly can you glean? What is the likelihood that these brick and mortar retailers or mall operators or anybody else actually come out of this on the better end of things, say 6, 12, 18 months from now?
Yeah, that's really, the story actually starts to get interesting around retailers when we get into June and we look at debt, mainly because the retailers came back to the corporate bond market. In particular, L Brands and Macy's in early June both issued secure offerings into the marketplace. I think the L Brands offering was a 6 and 7, 8, 5-year deal for about $750 million, and Macy's issued a similar deal, while larger. It was a secured deal at 8 3/8 for $1.3 billion. So that was basically the market accepting retailers back in terms of them taking those bonds off their hands and actually investing in them. What happened, though, coming into September is where we see a differentiation between how the investors are reacting to retailers. On a net basis, just looking at trading activity, bond investors have been net sellers of Macy's debt. And that's very concerning, because if Macy's is going to have to up the incentives for investors to take on their new issue deals, that means the cost of capital for Macy's in the debt markets is going to continue to go up because investors have lost faith. These are the signals that people need to look at when they're trying to understand what are the future of some of these retailers. Because clearly, Dom, they're going to have to borrow money to get through this storm and hopefully make it to Christmas and maybe bounce back. But if the cost of debt capital keeps on going up, it really reduces the chances that they're going to be able to recover.
All right, credit spread's a key focus there. Many of these companies can still borrow at semi or relative attractive rates. We'll continue to monitor that, and I'm sure, Chris, you will as well. Thank you very much for your insights, Chris. We appreciate it.
Thank you so much, Tom.
Shepard Smith here. Thanks for watching CNBC on YouTube.